Since the initial public offering in 2012, Facebook stock has returned a whopping 24% per year. Founded in 2004, Facebook has changed the world by creating the largest social media network. What started as a side project in a Harvard dorm room has turned into a multi-billion-dollar advertising company with nearly 2 billion daily active users. As part of the FANG stocks, it's no secret that Facebook is a dominant global company and stock market favorite. But the past is the past, and while it can help with analyzing the business, we must also look to the future to see what return we can expect from Facebook stock in the next decade. Before we get into valuing Facebook stock, we must understand Facebook's business. Facebook doesn't charge users for its core products like Facebook, Instagram, WhatsApp, or Facebook Messenger. Other businesses and individuals pay Facebook to run ads to a targeted market of users. Facebook is almost entirely a digital advertising company, with over 98% of revenues coming from advertisements. Constant research and development are needed to maintain and improve existing services, and it can take years for Facebook to monetize new products. On the bright side, Facebook does very little advertising to acquire new users. Instead, they grow organically through mostly word-of-mouth advertising. The digital advertising market has been dominated by Google and Facebook in the past, but the market is now slightly more fragmented, with companies like Amazon and new tech companies all over the world stealing market share. Facebook advertising has historically had extremely low acquisition costs for businesses running ads. So, Facebook has significant pricing power with unique user data on over 1/3 of the world's population. However, it turns out that some people aren't too happy with all of the data Facebook has on them. So, Facebook is under constant pressure from government regulators around the world, and the future success of Facebook's core advertising business has become more uncertain in the past few years. It's also important to consider some key ratios of Facebook's past. Here's a graph of Facebook's debt-to-equity ratio since 2011. As you can see, Facebook doesn't use debt. Facebook has grown almost entirely from issuing debt in the beginning and now through cash flows from operating the business. Other big digital advertising companies like Google are virtually debt-free too. The next key ratio to look at is Facebook's operating margin. Here are Facebook's operating margins since 2011. As you can see, they've been extremely high, likely because Facebook's revenue growth has outgrown its expenses by a long shot. However, now that growth is starting to slow, Facebook's operating margins are expected to slightly drop, with an expected operating margin of around 35% in 10 years. Still, these are phenomenal margins even for a tech company, and they show that Facebook is a dominant player in the market. But what is it that makes Facebook a dominant player? It has a lot to do with Facebook's economic moat and management team. Facebook's most powerful economic moat is its networking effect. With every new user that joins Facebook, Instagram, WhatsApp, or Facebook Messenger, the service becomes more valuable. Without needing to advertise, Facebook was able to grow exponentially by letting existing users convince their friends to make an account. How long did it take you to finally join one of Facebook's platforms? Few people would join if only a few of their friends were using Facebook's services. But now that everyone uses them, it's almost impossible not to use a Facebook service. Another part of Facebook's moat is the stickiness of their products. Facebook's platforms have nearly 2 billion daily active users around the world. By getting people on their platforms every day, more ads can be run and more revenue can be made. When it all comes down to it, Facebook doesn't pay to acquire new users and makes over $50 in annual revenue per user in North America and an average of $10 in annual revenue per user around the world. You don't have to do the math to see how powerful Facebook's economic moat really is. Now on to Facebook's management team. Facebook's chairman and CEO is Facebook founder and Harvard dropout Mark Zuckerberg. Mark Zuckerberg created the Facebook in 2004 and with the help of others has created the largest social media platform in the world. Zuckerberg has managed to grow the value of Facebook exponentially through internal investments and acquisitions like Instagram and WhatsApp. Zuckerberg is the largest individual shareholder of the company, owning nearly 400 million of Facebook's 2.8 billion shares outstanding. Even though he doesn't hold over 50% of the shares outstanding, Facebook's Class A and Class B shares structure allows Zuckerberg to vote with over 50% of the total stockholder vote. This means that only one individual controls the majority vote of the company. Therefore, if you are a shareholder in Facebook, it really is in Zuck we trust. Zuckerberg is paid a hefty $1 salary for his cash and stock compensation as chairman and CEO. But his total compensation includes private security and personal jet usage, so it ends up being around $24 million per year. The rest of Facebook's chief executives are heavily compensated in stock and long-term incentives. Facebook's chief operating officer holds over $350 million in Facebook stock. Employee stock compensation is also a significant portion of the research and development expense. So it's safe to say that the people running Facebook are incentivized to produce long-term value for the rest of Facebook shareholders. Now that we've taken a look at Facebook's business in the past, we can look to the future to try and estimate the growth in the next decade. Currently, the total global digital advertising market is around $310 billion. Businesses that already use digital advertising are expected to shift more of their marketing dollars to digital advertising, moving away from traditional marketing like TV and paper ads. In developing markets, more businesses are expected to use digital advertising as the businesses and developing economies grow. Therefore, it is expected that the total digital advertising market will reach $500 billion by 2024 and $800 billion by 2030. $800 billion would represent half of the total predicted advertising market spend in 2030, meaning that half of the global advertising market spend is expected to be spent on digital ads. Facebook and Google have historically held over 85% of the global digital advertising market, with Facebook holding about 33% of the market share. The market will likely fragment in the future, and the two companies will probably lose some market share. But for simplicity, I will assume that Facebook will maintain 30% of the digital advertising market share in 2030. I'm not including Facebook's VR and tech products division because it accounts for a small share of revenue now, and it's uncertain whether or not it will actually succeed. Therefore, all things considered, I have projected a per-year growth rate of 14% for the next 3 years, 10% for the 2 years after that, and 8% for the last 5 years. Using those growth rates, we can estimate Facebook's intrinsic value and whether or not it is a buy at current prices. Facebook's revenues are from all around the world, so I've considered each global region and calculated a weighted discount rate of around 7% for intrinsic value calculation. This discount rate is based on the equity risk premiums for various regions around the world and the fact that the U.S. 10-year risk-free rate is 1.1%. I've also assumed that Facebook's operating margins will gradually decline to 35% as the business matures and costs start to catch up to revenue growth. Capital expenditures are expected to remain at about 21% of revenues to maintain and grow the business in the next decade. Therefore, using the predicted growth rates, we get an intrinsic value of Facebook stock of $852 billion, or $295 per share using the diluted share count. Now let's see if this number makes sense. The revenues in 2030 are projected to be around $234 billion. If we assume that the global digital advertising market reaches $800 billion and that Facebook will have about a 30% market share, then this number would make sense. Given that developing markets could use more digital advertising than expected, and that the growth of the virtual reality and other tech products has a large potential upside, I'd say this is a fairly conservative valuation. The stock is currently priced at $267 per share, which is slightly lower than the intrinsic value calculated in this analysis. It's important to keep in mind that Facebook could potentially face significant headwinds against government regulators, and that part wasn't necessarily considered in this analysis. Full disclosure, at current prices, I'm not buying Facebook stock, but I invite you to make your own judgment of whether or not these inputs make sense, and consider for yourself what price you should pay for Facebook stock as an investment. I hope this was helpful. Please leave a like and subscribe if you want more content like this. What stock analysis do you want to see? Leave a comment down below, and I'll see you again next time.